Welcome to my channel. I'm Doris and I'm here to share with you about today's stock account update. Today my stock account has earned $3,907. All three major US indexes fell this week as inflation data reinforced the Fed's hawkish expectations. In my account today, I've earned $3,972, and that's a gain of 5.29%. So right now the net asset of my account is $79,000. Today SQQQ rose for 5.13% to $39.79, and the DRV rose 5.75% to $48.22. Today's market performed overall a loss, with Dow Jones Industrial Average decreased for 1.02%, Nasdaq decreased for 1.69%, and S&P 500 decreased for 1.05%. Most of the tech stocks made a loss today. The auto manufacturers lost 2.35%, and software infrastructure lost for 2.09%. Internet, retail, and software application all lost of more than 2%. US stocks closed lower on Friday, with all three major indexes falling for this week. One of the Fed's favorite inflation indexes showed upward US inflation pressures, reinforcing expectations that the agency will stick to its hawkish stance. The market thinks the risk of a Fed rate hike by a 50 basis point is rising. All three major US indexes fell for the week, with the Dow down 2.99% in the week, the S&P 500 down 2.67%, and the S&P 500 down 2.67%, and Nasdaq down 3.33%. On Friday, the 2-year Treasury yields rose to 4.8%, surpassing the highest level since the 2007 financial crisis, 4.799%. AQR hedge fund co-founder Cliff Asness warned Thursday that U.S. stocks are vulnerable to macro factors if inflation does not fall as sharply as markets expect. He said that, despite the decline last year, it was still expensive relative to historical levels. Asness believed that the macroeconomy may have a fat tail effect, that an extreme event with a small probability will eventually have a huge impact. He said, and there is a risk that the market is still not fully prepared for the macroeconomic outcome. U.S. investors welcomed a closely watched inflation report on Friday. The Fed preferred measure of inflation, the core personal consumer spending price index (PCE) rose 0.6% in January from the previous month, the biggest increase since August 2022. The index rose 0.7% from a year earlier. Both gains were higher than economists had expected. Fed officials have repeatedly said the core PCE is usually a better long-term indicator of inflation, as it removes the effect of price volatility in a short term of time. The data also shows that U.S. personal spending rose 1.8% in January from the previous month, the biggest increase since March 2021. Expected 1.3%, previously negative 0.2%. Analysts said the Fed's preferred inflation measure grew faster than expected in January, and the consumer spending saw the biggest increase since 2022, putting a pressure on policymakers to continue raising interest rates. U.S. consumer spending rebounded sharply in January, with strong revenue growth and accelerating inflation, which could add to financial market fears that the Fed could continue to raise interest rates throughout the summer. The interest rate market sees a risk of a 50 basis point rate hike at the Fed's meeting next month. The OTS contract related to the the March 2022 meeting suggests a 33 basis point increase, or 28% chance of a 50 basis point increase. Swap traders continue to price the expectation that the Fed could raise policy rates by 25 basis points in the next three meetings. The market now expects the Fed raise swap pricing policy rate to peak at 5.45% in July 2023. Treasury Secretary Janet Yellen said on Friday that a soft landing for the U.S. economy was a likely outcome because the U.S. labor market is strong enough to without the severe balance sheet problems that followed the global financial crisis. Yellen said, "I think achieving a soft landing is a possible outcome and what I hope for U.S. to achieve. The fundamentals for the U.S. economy are the same. If measured in 12 months, inflation is falling." But she warned that the labor market remained tight, the wage growth remained strong, and that core inflation, excluding food and energy, remained above the 2% anchor target, adding, "There is no work to be done to really reduce it." That's all I have for today. Thank you for listening. Don't forget to subscribe and like. See you next episode.